Risk management and trading discipline usually rank very low on the priorities list of most traders. In today's video, I will share 10 tips that will help you to improve your trade and risk management and avoid the most common problems that cause traders to lose money. Number 1. Never use fixed stop-loss orders. A common mistake is to use a fixed amount of points on your stop-loss and take profit orders across different instruments and even markets. Markets move sometimes erratically, sometimes with high volatility without any notice. As a trader, it's part of your duty to factor this into your decision-making process when deciding where to place your stop-losses. You cannot just place your stop-loss at a set distance on every trade and hope for the best. That isn't going to work and is not a viable strategy. You need to allow space for the normal vibrations of the market each day. There is something called the average true range of a market that will show you the average daily range over any given time period. This can help you to see the market's recent and probably current volatility, which is something you need to know when trying to figure out where to put your stop losses. Trading with fixed distances doesn't let you choose reasonable price levels, and it also takes away all the flexibility you need to have as a trader. Always be aware of important price levels and barriers, such as round numbers, common moving averages, Fibonacci levels, or recent support and resistance levels. Number 2. Don't close trades without a good reason. Have you ever exited a trade due to a fear of giving back unrealized profits, only to see the market continue in the intended direction? I'm sure you have, and if you haven't yet, you will. This is something every trader has to master, the ability to control emotions in a way that allows you to trade based on pure technical analysis. One way to keep your emotions in check if you feel the urge to close a position early is to simply ask yourself, why am I closing this position? If your answer is anything other than a technical one, you are likely making a decision based on emotions. Number 3. Avoid moving your stop to break even too soon. Moving the stop to the point of the entry to create a no-risk trade is one of the best risk management strategies you could use. However, one of the most common and expensive mistakes made by traders is moving the stop loss to break even too quickly. It is psychologically attractive to move a stop to break even in order to enjoy the feeling of removing risk, but it's not a smart thing to do, as it tends to result in being kicked out of a potentially profitable trade too early. So when to move your stop to break even? Rather than moving your stop to an arbitrary level, you should always aim to move it to a strategic level, one that the market has deemed important. A very common approach usually involves waiting for any of the following to occur: a failed retest of the entry point, a significant higher high or lower low that confirms the entry, a successful breakout in the direction of the trade, or a failed breakout against the direction of the trade. Number 4. Understand market correlations. Another tricky component to risk management is the ability to control exposure with correlated trades. When it comes to money and risk management, this means that trading instruments which are positively correlated will lead to increased risk. If you are a forex trader, you can often see a very strong correlation between certain forex pairs. If you are a stock trader, you'll notice that companies within the same industries and sectors often move together over long periods. For instance, you spot a rising channel on the pound dollar and you decide to set a buy order at the bottom of the channel. At the same time, you also see a bullish divergence on the pound yen, so you also decide to take that trade. When these trades are opened, then you will have two correlated trades that could either double your win potential if the pound keeps rallying, or double your losses if the pound suddenly sells off. This is why it's essential to avoid opening positions for highly correlated instruments. Understanding how the various instruments relate to each other and why some instruments move in tandem while others diverge allows for a deeper understanding of the market exposure. Number 5. Understand the impact of leverage on risk management. Leverage is simply a way of trading with more money than you actually have in your account. Now, using leverage can maximize gains, however, it can also increase losses too. If you are leveraged and you make a profit, your returns are magnified very quickly, but at the opposite side, losses will erode your account just as quickly too, and too many people have lost their entire trading accounts by the misuse of leverage. Remember, the greater the amount of leverage on the capital you apply, the higher the risk that you will assume. Selecting the right leverage level depends on your experience and risk tolerance. If you are conservative and don't like taking many risks, or if you are still learning how to trade, a lower level of leverage like 5 to 1 or 10 to 1 might be more appropriate. So familiarize yourself with leverage trading and remain conservative as you learn how to trade and build experience. Keeping your position small and limiting the amount of capital for each position is a good start to learning the proper way to manage leverage. Number 6. Keep a journal and review your trades. Most traders will never look at their trades again after they have closed them. They will just move on to the next trade, forget about what they did before, and completely avoid learning effects. Keeping a trading journal offers two potential benefits. First, it provides a place where you can come back to and revisit all your past trades to see what you have done wrong and how you developed over time. And second, it will keep you from making mistakes during your trading sessions. At the end of each week and month, go back and see what you did, notice common problems, and spot your strengths. These observations can help you exploit your strengths and highlight the areas you need to work on. The journal's objective is to monitor both the performance of your trading strategy and the ability to execute it with consistency. When you reflect on your entries after a month of trading, I assure you that you will learn a lot about yourself and about your trading psychology. Number 7. Give a stop loss room to breathe. Most traders misunderstand what a stop loss really is. At its core, the price level of your stop loss order is the price where your trade idea is no longer valid. Now, placing stops too tight is one of the most common mistakes traders make. Many traders are naturally drawn to and tempted to place as small of a stop loss on their trades as possible. Admit it, how many times have you been right about the market's direction, your trade signal was right, but you still lost money somehow? This keeps happening to you because your stop loss is too tight. The market can fluctuate unpredictable, and if you place your stop too tight, there's a high chance that you'll be stopped out before the price continues to go in your direction. It's important to give the price enough room to breathe, and of course, position sizing plays an important role in this equation. Number 8. Have a trading rules checklist. A checklist has similar benefits compared to a trading plan, but it serves as a great complementary tool. A checklist must state all your entry criteria underneath each other, and every time you are about to enter a trade, you revisit your checklist and check off the things you can see on your charts. With a checklist, it becomes obvious right away if a trade really matches your criteria or not. Again, if you can visually see that the trade that you are about to take is breaking your rules and that you should be staying out, you are more likely to avoid those painful mistakes. Number 9. Have realistic take-profit targets. Many traders put way too much emphasis on having higher take-profit levels and don't understand that this doesn't tell you anything about the quality of your strategy. You end up setting unrealistic profit targets far away from your entries, thinking that by using a wider take-profit you can increase your risk-reward ratio, but it's not as easy as that. Using a wider take-profit order means that the price won't be able to reach the take-profit order as easily, and if your stop-loss strategy isn't on point, you'll most likely see a decline in your win rate. You need to be able to determine a suitable profit target, one that gives you a realistic profit target, but also gives you a sensible risk to reward. There are many ways in which you can set your profit target using technical indicators and other tools, but two of the most effective ones are support and resistance levels and daily range levels using the ATR indicator. Number 10. Understand your fears in trading. Every trader, no matter how experienced or inexperienced, faces the same fears. In order to manage your trades and become consistent, you need to understand your fears. Maybe you get anxious when you are in profit and feel the urge to close the trade. It means you have the fear of profits becoming losers. Or instead of listening to your analysis, you fail to pull the trigger because you fear you have missed or overlooked something. That's the fear of mistakes. Or maybe you have the fear of being wrong. That's when you experience a few successes in trading and you start to develop an ego. Then, instead of making the trade that can make you the most money, you make the trade that best protects your ego. Or you suffer from FOMO, the fear of missing out, when impatience and greed take over and you enter the trade just because you feel the market is moving without you on board. You must know yourself and understand the fears that appear inside your mind when you're trading, because this is the first step towards conquering those fears and becoming a better trader. As always, if you learned something new and found value, Leave us a like to show support, subscribe to our channel and click the bell icon to stay in touch when we release new videos. Until next time.